$100 million, with an additional $300 million expected to come into the country by the end of this week. The money being sought by the National Treasury will be used to plug a 126 billion Kenya shillings hole in the budget. And as Faisal Ahmed now reports, analysts are skeptical over the facility due to its expensive nature.
Despite the government reducing its targets on syndicated loans from $600 million to $500 million, the money is expected to hit National Treasury accounts in two batches. The first installment of $200 million and the next one of $300 million expected this week. According to economists, the weak appetite by the international markets is as a result of unpaid loans by some countries in Africa, such as Ghana, putting more pressure on financiers. Also, the government is said to be expecting more funds from both the IMF and World Bank, hence the reduced appetite.
Might have slashed it because they are getting $1 billion from World Bank and 200 from IMF, which is concessional. So there might not have been a need to get the whole 600 million anymore, since the World Bank and IMF money is coming in May, just in a month's time. So they might have, the reason for the commercial was to bridge a gap, but the process for World Bank and IMF was faster, so they might have decided to slash based on that.
Some of these bonds, some of these banks are counting losses based on the event in Ghana. So they are looking at Africa as a big basket, and even the risk appetite, be it on the bonds or on the loan side, has sort of diminished.
However, they have been warned of two key matters when the government gets the money. The first one is on the repayment of the loans, which will vary on how the US Federal Reserves will put the lending rates. They have also raised concerns on the use of the funds, such as on recurrent expenditure.
The authorities will look at, okay, where are we in reference to the benchmark rate, secured overnight facility rate, and then they add on some premium. So the risk is that if in the US, they keep on increasing their interest rates to tackle inflation in their economy, it will have a negative knock-on to the borrowing rate that we'll be able to incur. So that is the main risk, going the syndicated loan route as opposed to Eurobond route, whereby the financing cost is cast on stone, unlike the fact that it keeps on adjusting.
The economists also dismissed fears that international markets have lost faith in Kenya, stating that if a Eurobond was to be issued, it would likely be oversubscribed, indicating faith in the country. On Valentine's Day, President William Ruto assured the country that it was in good standing with international markets.
The financial system in the world has opened the doors once more for Kenya. We can now go to any international financial system and ask on behalf of Kenya, and the doors are open for us.
The economists are, however, skeptical on the government's move to shift goalposts on the debt matter, stating that any government can manipulate debt to GDP ratios, which will allow it to borrow more funds. Faisal Ahmed, Citizen TV, Nairobi.